Good afternoon, ladies and gentlemen, and welcome to the BRICKABILITY Group PLC full-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we'd like to submit the following poll, and I'm sure the company will be most grateful for your participation. And in the first instance, it gives me great pleasure to hand over to Chairman John Richards. Good afternoon, John.
Oh, good afternoon. And I wonder, could you take us on to slide 2? Just introducing who will be presenting today. Myself, John Richards, Chairman, as has been said. Alan Simpson, Group Chief Executive, and Mike Gant, the Chief Financial Officer. Next slide, please. So, our highlights for the year past. It was a strong performance across all of the group's divisions, despite the tricky macroeconomic backdrop, particularly post-September 2022, with all the struggles that month brought us. We're continuing to benefit from the strategic decision to broaden the group's product portfolio and become less dependent on housing. When BRICKABILITY first floated, around about 80% of its products went into new housing. As we stand today, that's around about 50%, so a significant change. For the 12 months ended 31st of March 2023, revenue increased by £160.9 million to £681.1 million, of 30.9% on a reported basis, the increase there, and 4% increase on a like-for-like basis. Adjusted EBITDA increased by 30.4% to £51.5 million. We acquired Modular Clay Products, ET Clay Products, and Heritage Tiles during the financial year, and there is a strong pipeline of acquisitions available to us, which Alan will talk about in a little while. And I should say that Modular Clay Products, ET Clay Products, and Heritage Clay Tiles, again, are businesses that take us further away from bulk private housing and further into architectural specification, into other parts of the construction market. Our ESG strategy and roadmap is established and progressing well, and it proposes a final dividend of 2.15 pence per share, giving a total dividend of 3.16 pence for the full year, an increase of 5.3% on the prior year. The board recognises that we have significant headwinds and challenges, particularly in the housing sector, and there particularly in the private housing sector. But the board equally remains confident of the group's ability to deliver a long-term shareholder value, and trading in our current financial year has remained in line with board expectations. New slide, please. We always like to discuss the market in which we work, and here we have some details on the housing market, partly because that's the one that's being talked about so much right now, because that's the one that is very, very dependent on the prevailing interest rates and thereby mortgage rates of the day. If you go to the top right chart, UK dwelling starts, you'll see that in 2022, just under 200,000 new homes were started in GB. That's going to fall this year. You'll be aware of all of that from that which you've seen in the press and from statements by Persimmon, Barratt, Taylor Wimpey, etc., etc. And while they're all saying slightly different things, the best guess at the moment is private housing starts are going to fall by about 20%, whereas affordable or public housing starts less so, because it's a completely different funding model, as you'll know. We're expecting that number of just under 200,000, therefore, to be around about 166,000 new starts this year. So a significant drop, but down to a level which we last saw in around about 2014, maybe as good as the numbers in 2015. What does that mean for brick dispatches? Well, the chart next door to it on its left shows that last year, 2022, 2.52 billion bricks were dispatched and used in GB, of which 1.94 billion were used in this country, the orange part of the bar chart, and 560 million were imported bricks. That 560 million was a record, the largest number ever. The effect on the reduction in new house starts on our business and on the brick business generally would be probably to bring it down to around about 2 billion bricks dispatched and used during 2023. New builds by property type, the chart on the bottom right, well, that shows that in 2022, 31% were detached houses. We expect that to rise a little during this year. And the reason for that is that the 27% that apartments made up of the statistics in 2022 is likely to fall because first-time buyers often go to apartments. And with the removal of Help to Buy 2 and the higher interest rates, it is the first-time buyer segment that's being hardest hit. So proportionately, we expect that to fall, and we expect detached houses to rise a little. That's good for our business because a detached house uses more radiators, more bricks, more roof tiles, etc., than does an apartment. In terms of brick manufacture, stocks and production in GB, if you look at the bottom left chart, you'll see that at the end of 2022, there were 305 million bricks in stock in GB at British manufacturers. That number today is already 530 million. It's rising by 40 million per month. However, we do need the number to be much higher. A good working stock in GB of bricks in factories is around about 700 million. And that's the sort of number that gives the right sort of inventory so that good customer service can be provided. So we have a few more months to go where we can afford to keep putting extra into stock to build that inventory. Beyond that, manufacturers may have to slow some of their factories for a period of time. Move on to the next slide, please. I want to briefly mention our ESG strategy. It's very, very important to the business. We are committed and signed up to the Quoted Company Alliance. We're doing an awful lot with our carbon footprint. Our electric vehicle rollout for company cars has already taken place. We're encouraged by some of our major customers to join the Supply Chain Sustainability School, which we did, and we achieved a gold level membership. We have committed to net zero by 2030 in our operations, and in the last year we appointed 2 independent female non-executive directors. So on to some of the numbers. Mike.
Just bear with us, Mike. If you could just allow us to turn on the camera and microphone, that'd be great. Thank you. Do bear with us just 1 second, John, while we just bring the guys back in. Thank you. I'll just take your camera down for 1 moment, John, whilst we bring Mike and Alan back in. Go ahead, Mike and Alan, the floor is yours, sir.
Have we lost JR?
No, JR is just camera down while you're presenting, sir. I'll bring him back up now.
Was he finished then?
He's finished, sir. Yes, please move on to your slides. Thank you, Alan.
Right. Right. Apologies, we lost you there. Sorry, in the signal. So it's myself, Mike. I'm just going through these financial slides. Thank you, everybody. So, as you'll see on slide 7, FY23 was another significant year of growth for BRICKABILITY. Group revenue for the year increased by 161 million to 681 million, an increase of 30.9%. Adjusting for the impact of acquisitions, year-on-year revenue grew on a like-for-like basis by 4%. Our timber business had an exceptional performance in FY22, as we previously reported, and so, as expected, during FY23, revenue fell back. Group revenue across all categories, excluding timber, grew by 15.4%, on a like-for-like basis. Gross profit increased by 26 million to 113 million, increase of 30%, and gross profit margin reduced by just 10 basis points to 16.6%. Now that margin dilution resulted from the additional 3 months of contribution from Taylor Maxwell Group, which compared to the prior year, which operates at a margin lower than the group average margin. And the normalisation of timber margins was also a factor as well. And these were largely offset by the contribution of recent acquisitions, which operate at a higher than average group margin, and the margin recovery within our contracting business. Adjusted EBITDA of 51.5 million was an increase of 30.6%, and adjusted EBITDA margin at 7.6% remained constant year on year. Adjusted profit before tax was 44.6 million, leading to an adjusted earnings per share of 11.93 pence, an increase of 18.6%. There is a slide coming on in the detail. I actually don't know whether you've been sent the pack or not, but there is a slide that explains our other items that you can see on this financial summary, but they are mainly acquisition related and non-cash in nature. Net debt at the year end was 8 million, and I've got a slide later in the presentation where I'll go through a few of the key movements there. And finally on this slide, as John has already said, the proposed final dividend for the year is 2.15 pence, which takes the total dividend for the year to 3.16p, an increase of 5.3% and a cover of 3.8 times. If you could move me on to the next slide, please. So this slide really brings to life the transformation that the group has seen, particularly in the last 2 years, but certainly since IPO. Since IPO, the company has successfully acquired 11 businesses, set up a joint venture in Germany, various startups, and developed and launched a range of new products. Revenue has more than trebled, EBITDA has pretty much trebled, EPS has increased by a compound annual growth of 18%, and the company pays a meaningful dividend. Just disappointing from our point of view that none of this is reflected in our current share price, but that therefore leads to the opportunity. Next slide, please. So building on the previous slide, this chart shows that BRICKABILITY hasn't just grown, but it's diversified as well, bringing significant exposure to a number of categories now, which are in high growth themselves, such as solar, renewables, cladding, balconies, product segments that we talked about, and have the potential to be significant segments themselves in the future. Since IPO, revenue has grown by almost £500 million. 377 million has come from the post-IPO acquisitions that I mentioned before, and 117 million, therefore, has grown organically. And that's a compound growth rate of 17.5% per annum. Can you move me on to the next slide, please? Thank you. So returning back to the FY23 results, this slide shows a segmental analysis of group performance. As you can see from the first table, the group has delivered revenue growth across each of its 4 divisions. Excluding timber, bricks and building materials like-for-like growth was 17.1%. Importing includes the 3 acquisitions that were made in year, and contracting benefits from the full year of Beacon Roofing, which was acquired at the end of March 2022. As you can see from the bottom table, contracting EBITDA margin has improved year on year, and this has been the input price recovery that we've seen throughout the year, following a massive increase in input prices the previous year. Distribution margin has been diluted by the growth of the businesses within the division that was operating above the average group margin, the lower than the highest margin business within that division, which is our Tower Rads business, which has a significant gross profit margin. So, as I say, the margin move down there is just simply because those are the businesses within the division have grown significantly. Next slide, please. So this slide shows the analysis of cash flow. We started the year with net funds of 400,000. The operating cash flow before working capital was £46.2 million. On this analysis, I've moved an item of deferred consideration, which for accounting reasons sits within other creditors and therefore within working capital. I'll move that out to a bar to add it to our other deferred consideration numbers. And so what this shows is a working capital inflow of 3 million in the first part. The 3 in-year acquisitions amounted to 12 million net of the cash acquired. Tax was 11.1 million. We spent 9.8 million on fixed assets, mostly property, which is the U Plastics branches and a warehouse for our U Power business, also a yard in Glasgow, a few other things as well. And then the loan and further investment in our German joint venture was 3.4 million. Bank and lease interest paid was 2.1 million. Finance leases were 2.8 million, and deferred consideration, which includes the amount I just referred to before, which has been reclassified in this analysis, amounted to 7.8 million. Dividends paid were 9.1 million, giving us a net debt at the end of the year of 8 million, which is 0.15 times on a net debt to EBITDA basis. Our current RCF is 60 million with a 25 million accordion. And with that, I'll hand over to Alan, who'll take you through the operational highlights.
Thanks, Mike. In the last 2 years, we've seen a significant increase in scale and also an expansion of our range of solutions and our customer base with an increase of 500 million of revenues over that period. We've diversified the multi-business strategy and it continued with 3 further acquisitions. As mentioned previously, there have been growth across all 4 divisions. Significant year-on-year price inflation has been mitigated. The financial reduced brick prices in volume 2. Timber volumes and prices fell back from exceptional highs as expected and are back now to normal levels. Our cladding division has performed very strongly in the year, and our ESG strategy has established and progressing well, as John mentioned earlier. If you move to the next page, new Bricklink yard in Glasgow. We didn't have a stocking operation up there with Bricklink, and he's building a strong merchanting base, also being the sole area for James Hardy plank boarding. Architectural facades partnership with Thurston Crop UK, with the balconies is successfully through the testing stage, with inquiries for year 24, very encouraging. The importing division has been strengthened with further acquisitions. The bespoke Brick Geek programme received RIBA accreditation. Bespoke have also invested in a sustainability school and showroom to showcase the group's sustainable focused products that we offer. Contracting also saw good demand and margins improved through cost inflation recovery. Next page, please. Thank you. U Power, our solar renewable business, first full year of operation within the group, continues to win major contracts. We bought a new warehouse. Part L legislation is effective from the 15th of June this year, and we've signed up with Barratt's, Taylor Wimpey, Morris Homes, local taken to deliver 14,000 roofs over the next year. We've opened 2 new branches for used plastics, which does James Hardy board as well, plus fascia, soffit and guttering. Tower Rails has bought underfloor heating in-house. We used to sub it out. This will increase Tower Rails margins on that part of the business. The Sherrenbecker factory is operational towards the end of this year, making plain clay tiles during a challenging period over last summer due to fluctuating gas prices. We've also invested in people with recruitment at both group and divisional level to support the growth of the business moving forward. And we've also employed 10 apprentices across the group, which will be rolling out on a yearly basis. We're also rolling out the new IT system to standardise it across the group. Year 23 acquisition updates, modular clay products for 4.75 million, increased our presence in the specification sector in London. Also brought access to a new range of European manufacturers, which BRICKABILITY and Taylor Maxwell didn't have access to. ET Clay and Heritage Clay tiles, 11.6 million. Gained wider access to a range of overseas manufacturers in tiles and various types of bricks, increasing our import capacity. And it also has 2 yards where we can stock products in the UK. 24 acquisition update pipeline, Precision Facades, which is part of SBS, part of the group. Very small acquisition, patented framing system for cladding was finalised. And then moving forward, we're looking at a specialist cladding business in the north and one in the south, a further roofing contractor and a roofing contractor group, which will diversify us again, reducing our exposure to just the house building market. Thank you. Over to you, John.
Thanks. So, in terms of outlook, the significant increases in interest rates are impacting housing starts and completions. But the general construction market is strong and it is set to grow further. Recovery forecast in the housing market, well, forecasted from late 2023 to early 2024, it's all dependent on interest rates. But as many of you will have seen today, inflation the rate of inflation was less high than some had forecasted. And so the interest rate maxing out at 6% is now forecast to max out at slightly less at around about 5.75%, which is, while a small reduction, still encouraging in the right direction. The market fundamentals for housing remain strong in just about all of them. Very, very strong indeed. The need for housing is huge. We've underbuilt for so many years. The population increase, the rate of household formation, the aging housing stock in the UK. And if I told you that every new house built today, bearing in mind the rate of house building, every new house has to last 600 years. And clearly it won't anything like that. So that's the strength of the requirement for home building that we have. As Alan's just mentioned, the group continues to very much diversify its offering, and more of that on the next slide. And trading, to repeat this, trading in the current financial year to date has remained in line with board expectations. Next slide, please. Up until this round of roadshows, we'd always just use the image on the right-hand side, the complete residential solution, pointing out all the different parts of a house that can be constructed using BRICKABILITY Group products. But as we've diversified our end user customer base more and more, and indeed the products that go into those customer bases, we thought it appropriate to show an office block here where we can supply metal cladding or insulation or brick slip cladding or stone cladding or balconies or solar panels. These are all things that we didn't have going into the general construction sector going back 3 or 4 years, but today we do, and those things are going to be growing. So the case that we have, we believe, on the next slide is that we are a market leader in construction material supply and contracting services. We have a strategy of growing and diversifying. Since IPO, revenue has grown by 500 million, while the proportion of brick revenue has shifted downwards from about 80 to about 60%. Our growth strategy is driving EPS, with it having grown from full year 2020 7.27 pence to full year 23 11.93 pence, a CAGR of 18%. 11 acquisitions since IPO. Since IPO, dividend per share has increased from 1.95 pence to 3.16 pence. And our ESG credentials, particularly with our new U-Power business, leading the field in solar panels, car chargers, etc. Big future for this business in sustainability. So we pause for questions, and I'll start by pressing.
That's great, John. Let me just give you a couple of moments to access the platform, and you can see the questions submitted from investors. But ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while John, Alan and Mike take a few moments to review the questions submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the Q&A, will be available via your Investor Meet Company dashboard. John, Alan, Mike, you can see you've had a number of questions from investors. So firstly, thank you to everybody for your engagement. If I can just make sure that you guys got the Q&A tab open and you can see the questions.
Yeah.
Are you all right there? So maybe, Mike, if I maybe hand back to you, if you want to start reading out any of the questions where you feel it's appropriate and then maybe dish them out, or John, you can do the same.
Yeah. Well, I'm going to start off, give me time to read through the ones, the financial. Sure. I'm going to start off with a question that's for John and Alan. It says, why do brick manufacturers dropship via BRICKABILITY? Surely they could just sell direct and take your margin away.
Mike, I'm sorry, I can't find that one. Can you? I've got it. Dropship via BRICKABILITY. Oh, okay.
Why did you use BRICKABILITY?
Yeah, I've got it. I have got it. Why do brick manufacturers dropship via? Okay. As you may or may not know, I used to be at the Ibstock business, the biggest of the British brick manufacturers. And we did used to sell some of our bricks direct to house builders. Indeed, I was the instigator of the majority of those deals to Barratt, to Redrow, to Taylor Wimpey, for example. But what you have to remember is several things. Firstly, it's hugely expensive for manufacturers to sell direct, hugely expensive. You need a very big sales force, which manufacturers don't have. You need a lot of boots on the ground. You need a lot of technical expertise people, which manufacturers don't have. So it costs them a lot more in terms of overhead to sell direct. They would need credit control departments many times the size of the ones that they have now. But there's another reason, and that is that the lowest prices you get as a brick manufacturer are direct from the major house builders. They nail you to the wall in terms of price. So if you take Ibstock, for example, they will only want to sell a certain proportion of their annual output direct to house builders because it costs them more to do it, and they get less per 1,000 bricks when they do it. That's what distributors like BRICKABILITY bring to brick manufacturers. And furthermore, a major house builder can order from the likes of an Ibstock or a Forterra, but it's not binding. And if they walk away to a cheaper offer, or they just sell less houses that year, then the likes of Ibstock are left holding those bricks. BRICKABILITY don't do that. When we make a commitment to Ibstock or Forterra, or let us say a Wienerberger, then we deliver what we promise to deliver. We take those products, we pay them on time, and we look after the credit control for those sales, etc., etc. So it is a no-brainer. It's a no-brainer to use distribution. I tried it both ways as a manufacturer, and that's one of the reasons I came here, because using distribution for a brick manufacturer works.
JR, I don't know if you can see, but there's one directly underneath that question that's sort of connected to the market. So that how fragmented the market is?
Okay, so in terms of brick distribution, the market used to be incredibly fragmented, full of lots of owner-occupier businesses right throughout the country. As we stand today, it is really very much more consolidated. I'll put the major builders merchants aside because they tend to hold bricks for housing extensions, the odd single property, bases for conservatories, garage extensions, etc., etc. So if you take pure brick distributors like BRICKABILITY, there used to be one major similarly sized competitor, Taylor Maxwell, and now that's part of the BRICKABILITY group. There was a mid-sized competitor, E.H. Smith, who still exists, but the majority of the distribution market is now merged or acquired, and it is very much consolidated apart from odd geographic outposts. What makes us different? Well, firstly, it's scale. It means that anybody who buys from us knows they're getting the best prices, because whether it's Ibstock, Forterra or Wienerberger, we tend to get the most advantageous prices because we buy so many bricks from them. Secondly, we get the maximum levels of rebates, again, because we buy so many bricks from them. So we're always extremely competitive, although in terms of rebate, we keep that and let that flow through to our bottom line. What else makes us different? In times of real short supply of product, because of our scale, again, people like Ibstock, Forterra and Wienerberger ensure that we're the first to get served with product, and maybe some of the very small regional competitors are not. So if we've made a commitment to an end user that we will supply, we know and they know that we will get that product from the manufacturers and we will be able to supply. That makes us different.
Right, JR, I'm going to try and trawl through some of these questions and answer some financial ones. There's a question about a outlook and a downturn and what that would impact us. I just want to reiterate and answer that question. Just kind of reiterate the point that John made at the start, that we are planning on a 20% reduction in housing units in the private starts in the year. That's built into our numbers that are in the forecast. So we've already assumed that in our numbers. I think that sort of answers that question. There's a question, I've lost it now, but there was a question about loans and borrowings, and also a similar question about the cash flow, working capital cycle and payment terms and such like. So I'll try and amalgamate a number of different questions together. Effectively, as you see me say, our net debt at the end of the year was £8 million. Our general cycle is that throughout the year is that by the half year we tend to have a cash outflow. It's not so much coming from trading, it's just the way in which we do various different payments through the business outside of the general sort of cash flow, including deferred consideration, acquisitions, various other things. So generally speaking, at the half year we have a cash outflow, and then overall the cash comes back in the second half of the year. There was a question about borrowings as well, which is related to that. And as I say, it's linked to that same thing. The borrowings in the first half of the year tend to go up a little bit as we pay more money out, pay the dividend out and various other things. And then the cash flows back in the second half of the year. There was a question somewhere, I can't find it now on here, about non-current payables, I think it is, and that would be mostly related to contingent consideration payments. So this is payments for earn-outs for acquisitions. There was a question about are we planning any share buybacks? And we're not. And there was a question somewhere about the returns on our on our investments and acquisitions, and it's not something we quote or disclose, but to give some guidance, generally our returns are 20% plus on our acquisitions and related investments. If that gives you some sort of guidance within the range of what we say to people. IT, there's a few things about IT and the IT systems and rollout. So yes, we're rolling out a core IT back-end ERP system. We're doing it in a very managed way at the moment. We've rolled it out across. It's already a IT platform. It's that we have in the business when we acquired Taylor Maxwell. It's Microsoft Great Plains. So we already have a base there, and we're rolling it out across the rest of our estate. So it's in 19 businesses at the moment, covering about 60% of our revenue. And the person asking the question notes the risk, and yes, we're aware that obviously IT rollouts can be risky, but I think we're doing it in a managed way, and so far so good. It's been fine. And again, we haven't disclosed the cost investment associated with that, but it's not hugely significant because we're doing it with our in-house resources. JR, I don't know if you can see it.
Yeah,
question.
I've got one here, Mike. Jay, have you seen major builders increasing working directly with manufacturers? I think we've answered that already. The answer is no. The opposite is happening. The major brick manufacturers are coming more and more to us to sell their wares. And why is the share price grinding lower despite company executing well? Is management aware of any significant factor impacting the share price? Well, frankly, we know that we're subject to market conditions like anybody else, and shares generally and shares on AIM particularly are not in a great place in GB right now. However, in terms of the share price, because we have executed well, everything we've said we would do, we have done. We've usually exceeded. I think in every single year we've increased our guidance again in terms of adjusted EBITDA. We said that we would acquire businesses. We said we would diversify. We've done all of these things. We really haven't got anything wrong thus far. So the fact that the share price has grinded lower is hugely frustrating for us. And are we aware of any significant factor? No, we are aware of our huge frustration with the share price, though. There's another question. To what extent does RMI, repairs and maintenance, offset declining new builds? Not a huge amount in this business. Only about 5% of our turnover goes into RM&I. However, what does offset it somewhat is the great increase that we have of product going into general construction, architectural specification construction, and infrastructure.
I think that's most of the questions now, Joe.
Is that okay there, John, Mike, Alan? If there are any other questions that you want to take on, we can provide those post the meeting, and then of course we'll publish anything further to investors at the appropriate time. If there are no further questions that you guys have there to address, I know investor feedback will be important to you. What I'll do shortly is I'll redirect those on a call to give you their thoughts and their expectations via feedback. But John, before doing so, maybe if I could just come back to you just to ask you just for a few closing comments to wrap up with, after which of course we'll redirect investors to give you their feedback.
Well, I think I would say that I've just said that we find the share price frustrating because we have a track record where we've delivered everything that we promised. At the moment, we do recognise the headwinds and challenges that face us. It's quite clear private housing is going to be significantly down this year. But remember, only 50% of our business goes directly into private housing these days, and the rest of the construction market is looking and feeling strong, and our numbers would tend to reflect that. And once inflation does get to a degree under control and mortgage rates start falling, as is always the case after a slight slowdown, very, very quickly the housing market can catch fire in this country, and always that happens following a slight turn down, and particularly when the fundamental need for housing is so very, very strong as it is in this country right now. And we don't fear any change of government. Government tend to know that housing is extremely important for the GB economy. And for the last 10 years, for the first time in my working life, housing has tended to have cross-party political support. That's it. Thank you.
That's great. John, Alan and Mike, thank you very much indeed for your time and for updating investors this afternoon. Could I please ask investors on this call not to close the session, as we'll now automatically redirect you so you can provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of BRICKABILITY Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.